Today, I wanted to go over this Reuters article titled U.S. Producer Inflation Subsides as Energy and Food Prices Drop. So there was actually some pretty good news yesterday. The Fed ended up meeting. They did not raise the federal funds rate, which is actually the first time since I think it was March of last year of 2022. So, and we did get some new information that came out as well, showing some positive trends that ideally the Fed wants to see. So this is good news moving into the future. And basically what I want to do is go over the article and kind of, I'll just highlight or go over the highlights of the article and explain what this means for real estate, or what I believe it means for real estate. So basically, U.S. producer prices fell more than expected in May as the costs of energy goods and food declined, signaling that inflation pressures were abating throughout the economy and could eventually provide relief to consumers. So basically, producer prices came in, and they actually came in lower than expected. So it fell 0.3% in May, and overall for the year, we're at a PPI of a positive 1.1 year over year, 1.1% that is year over year, which is the smallest gain since 2020. So basically, since the pandemic, we haven't seen numbers like this in a while. So that's good. And then basically some other statistics. So that was the PPI right there. It says it followed data on Tuesday showing that consumer prices, so CPI, as opposed to PPI, edged up in May with the year-on-year rise the smallest since March of 2021. So two good reports there in a row. First, the PPI is the smallest gain since 2020, as well as the CPI, smallest gain since March of 2021. Federal Reserve, again, like I mentioned at the top of this video, kept their interest rates unchanged for the federal funds rate. And essentially, they did hint that they are willing to still increase the federal funds rate by another 0.5 percentage point. So whether they do, a couple of 25 basis point hikes later in the year, it just depends on the labor market, because really the labor statistics have come back very strong. And despite what that means for Americans, normally you'd think, okay, awesome, labor's strong, the economy's going well. The Fed actually, doesn't want to see that, because if wages increase, if unemployment is low, if businesses are hiring more people and people are switching jobs to make more money, again, it's good for that individual, but what the Fed sees it as being bad for the economy, because when people make more money, they spend that money, and when they spend that money, it's going to not help their case or their cause in trying to lower inflation. So it depends on the labor market, but it looks like the Fed at least has put a temporary pause on hiking their federal funds rate. So that's what we're going to be looking at over the next few months. Again, it just kind of goes over, food prices falling, everything like that. That's good. Food commodity prices dropped back to levels seen prior to Russia's invasion of Ukraine about 15 months ago. So again, all positive trends, I would say, with the exception of just a very strong labor market, which is not what the Fed wants to see. It says that, once again, it goes over the PPI right there, smallest year-on-year rise since December 2020. And then it does say that inflation is subsiding as supply chain bottlenecks disappear and demand for goods slows in response to higher borrowing costs. So again, that's part of what the Fed has done, is they've increased the federal funds rate, which doesn't directly affect consumers, but it does make borrowing for banks and everybody else, basically, the larger institutions, much more expensive. So when you're paying a, 5.5% federal funds rate as opposed to 0%, it it disincentivizes people to go out and take risks and start new businesses or do anything like that. It does say that the economy is resilient, and again, despite some of the good news right there, it did say stocks on Wall Street fell, um, and then basically what we're looking at here, the Fed officials did raise their core PCE, so that's like personal consumption inflation, from 3.6% to 3.9%. So they're expecting by the end of the year, basically we'll be at 3.9% for core PCE. And again, they want to get that number down to 2%. So in my opinion, with how quickly and aggressively the Federal Reserve increased their federal funds rate, starting really, uh, 15 months ago or so. I mean, they started increasing it in the beginning of 2022, but they really started ramping it up March, April, May, and going on throughout the year. A lot of that stuff, it just takes time to work through the system. A lot of economists that I listen to say that it's going to take 12 to 18 months for the effects to really take hold, and we did see some negative impacts there, with some of the banking crises that were going on. But yeah, I mean, it's going to take a little bit of time. So I think that hopefully the Fed just kind of stays the course as far as pausing interest rate hikes, because inflation is showing that it is getting under control. We were at like 9%. I believe I'm quoting this off of the top of my head, but like, we were nearing double digits at certain points last year for CPI, and now we're way down. And honestly, when you're considering year over year changes, I think it's only going to get better as prices stagnate. So that's the good news. How I think that affects real estate is, I think that once we have more stability, and we're not constantly changing interest rates and tinkering with things, that prolonged stability, where we have basically interest rates staying within a quarter of a percentage point for duration, then I think that's going to give everybody more confidence in the market, and that's where you might see sellers start selling again. Buyers, we still have strong buyer demand, even though that has been crushed over the years, or over the past year, compared to where it was. It still is very high, and exceeds supply in many areas, including here in Northeast Ohio, which is why we're still seeing such short days on market, like relatively few days on market when you think from a historical context. Now maybe we're seeing 2 weeks on market for the average, or the median, I should say, whereas historically you would see 30 to 60 days or more, depending on the time period. So overall, I think things are trending in the right direction. People are still saying that they think that there's going to be a recession within the next year or so. That has been basically a common refrain for the past year, though, and I'm hoping that we can truly have a soft landing. If all of these companies and everybody is essentially bracing for it, we just need to get our spending under control, as a nation, honestly, because credit card debt has gone higher than ever. And realistically, again, when you're spending money that you don't have, that's not good anyways for your personal bank account, but also just when you're spending money. Yes, we want the economy to do well, but that's what's going to keep bumping inflation numbers up, which is what the Fed doesn't want to see, and you're kind of forcing their hand, um, if they're not seeing the inflation numbers that they want to see. So, just my 2 cents on this. If you have any questions, mostly regarding real estate, because that's what I actually do. That's my profession. Feel free to reach out to me. I do like to keep track of the news and the economy and stuff like that, but not an economist, just a real estate agent. And if you're looking to buy, sell, or invest in the Cleveland, Ohio market or anywhere in Northeast Ohio, feel free to reach out and have a great day. Thanks.